Iron Financial. We're here to help you forge a stronger, more resilient portfolio by cutting right through the market's weakness. And today, we are putting American Airlines, ticker AAL, directly under the microscope. Now look, this is way more than just another airline stock analysis. I want you to think of this as a stress test. You've got a company posting all-time record revenue, but then somehow missing its earnings by a country mile. It's getting absolutely hammered by external shocks, yet it's guiding for a massive blowout year in 2026. So, what is going on here? Is this the blueprint for a powerful, durable turnaround? Or is the entire structure about to give way and collapse? The answer, I promise you, will tell you a lot about the market's real appetite for risk right now, and whether you should be buying the fear or running for the hills.
Okay, let's just cut right to the chase, because this slide right here is the entire story in a nutshell. On the left, you have the brutal reality, a disastrous, jaw-dropping 58% miss on earnings per share. I mean, that's not a pothole, that's a crater. But then on the right, you have management coming out and promising a 2026 that's a full 12% better than Wall Street's already pretty rosy forecast. So the question is simple, and it's the only one that matters. How can a company fail this spectacularly in one breath and then promise you the moon in the next? Which side of this slide do you actually believe? Because right now, the market has made its choice, loud and clear, and it is not buying the promise. Not one bit.
Exactly. And to figure out which side is right, we are going to put their entire strategy on trial today. Here's how we're going to break it down. First, we're going to dissect that earnings paradox and the massive credibility gap it's created. Then, we're going to get out the magnifying glass and investigate the deep cracks that appeared in their Q4 foundation. After that, we'll pivot and inspect the new premium fortress strategy they claim to be building. Now, a huge part of that is what we're calling the A Advantage engine, their loyalty program. Then, it's time to get tough. We will stress test the entire blueprint, pitting the bull case directly against the bear case. And finally, we will deliver Iron Financial's verdict. Is this a generational buying opportunity, or is it a classic value trap waiting to spring? Let's get into it.
Right, so this credibility gap we're talking about, it's not just Wall Street jargon. It's a fundamental breach of trust with investors. When you come out and you miss estimates this badly, the market basically slaps a massive discount on everything you say next. It puts you in the penalty box, and you have to earn your way out. It's that simple. And frankly, the market has every single right to be skeptical. Execution is everything in this game. You can have the most beautiful, intricate blueprint in the world, but if you can't deliver a solid quarter, that blueprint is just a piece of paper. The burden of proof has now shifted entirely onto Americans' management. They have to prove, beyond a shadow of a doubt, that Q4 was a fluke, an anomaly, and not the new ugly normal.
Yeah, and let's be perfectly clear about the scale of this failure. The smartest minds on Wall Street, the analyst consensus, they expected 38 cents per share. American Airlines delivered just 16 cents. That is a 58% miss. Now, for a huge, large-cap stock like this, we're talking about one of the biggest, most established companies on the market. That is nothing short of a catastrophic failure for a single quarter. It really only signals one of two things, and neither of them is good. Either management is completely flying blind and has zero visibility into their own operations, which is terrifying, or their entire business is so fragile, so brittle, that just a slight headwind is enough to send them into a complete nosedive. Either way, it's not a good look.
So, what exactly were those headwinds? Well, management was quick to point to a series of external shocks that just rocked the quarter. Now, the bull case, the optimistic view, says these are just one-time events, a string of bad luck that's now in the rearview mirror. But the bear case, which is my case, says this is the new, chaotic reality of running an airline. It's unpredictable, it's uncontrollable, and it's absolutely devastating to the bottom line. So these numbers we're about to see, they aren't just excuses from management. They are hard evidence of a fundamental, structural weakness in the business model itself.
First body blow, a government shutdown. This wiped out an estimated $325 million in revenue. Just gone, poof. Now, an optimist, a bull, might say, well, that's not their fault. But a serious investor has to ask a tougher question. How durable is your business really if political gridlock in Washington, D.C. can instantly vaporize $250 million from your top line? It exposes a deep, unsettling vulnerability. A fortress, which is exactly what they claim to be building, is supposed to withstand these kinds of tremors. This suggests their foundation has some pretty serious cracks.
And it didn't stop there. Next up, Winter Storm Fern hits, costing them another $150 to $200 million. And look, of course, you can't control the weather, but that's the absolute core of the bear thesis. The airline industry is perpetually, endlessly at the mercy of things it cannot control. Fuel prices, global health crises, geopolitics, and yes, the weather. So when management gets on a conference call and issues guidance for a perfect, sunny year ahead, my question is always the same. Have they priced in the next storm, the next shutdown, the next oil spike that comes out of nowhere? The market, by selling off the stock, is screaming that they haven't. In this quote just perfectly captures that deep-seated distrust. It's not that the market thinks management is actively lying about their plan. No, they probably do have a plan that, on a spreadsheet in a quiet, air-conditioned room gets them to $2.20 in earnings per share. The problem is that airlines don't operate in a quiet room. They operate in the real, messy, chaotic world. So the market is looking at that plan and saying, your plan is irrelevant. It's a fantasy, because reality will inevitably show up and destroy it. This right here is the psychological barrier the stock has to overcome. It is a full-blown crisis of confidence.
All right, you've laid out a very strong bear case. The Q4 cracks are undeniable and the market skepticism is completely justified. I get it. But here's the thing. Judging a company solely on one quarter that was plagued by external shocks, well, it's like judging a skyscraper's structural integrity during a 9.0 earthquake. To get the real story, what we need to do now is inspect the blueprint. We need to analyze the actual steel frame of their turnaround strategy to see if they are, in fact, building something more resilient for the future. Because beneath all the rubble of Q4, they were busy laying a new foundation, and we need to examine it piece by piece.
Now let's get to the bull case. And the first piece of evidence is a big one. $54.6 billion. Despite the government shutdown, despite the winter storm, despite all the headwinds you just mentioned, American Airlines posted $54.6 billion in revenue for the full year. This is a record. It is an all-time high for the company. Now, this is a crucial point because it tells us that the underlying demand for their core product, getting people from point A to point B, is incredibly strong. The engine is running faster and harder than ever before. The problem in Q4 wasn't the engine, it was the drag. And the whole bull thesis rests on the idea that if they can reduce that drag and tune the engine for higher profitability, the raw power is already there.
And this slide right here shows exactly how they plan to do it. They are fundamentally changing their product mix. Take a look at this. This is their new flagship suite. This isn't just a refresh. They are making a massive, company-altering strategic pivot away from the old model of just cramming more and more people into low-margin economy seats. Instead, they're re-engineering their planes to focus on high-margin premium customers. And the strategy is explicit. Their premium seat capacity is set to grow twice as fast as the main cabin all the way through 2030. So this isn't just about new seats, it's a whole new business model. They're actively choosing to sell fewer but much more expensive and profitable products. It's a deliberate shift from a volume game to a margin game.
Of course, a strong strategy is completely useless without a strong balance sheet to support it through thick and thin, and this is where management has been doing some serious heavy lifting, quietly, behind the scenes. Just look at the numbers on this timeline. They started 2024 with a mountain of debt, $38.6 billion. A year later, as you can see, it's down to $36.5 billion. That's over $2 billion in debt paid down in a single year. And they're not stopping. They are accelerating, now targeting getting under $35 billion in 2026, a full year ahead of their original schedule. Every single $1 billion of debt they eliminate makes the company stronger, more flexible, and better able to withstand the very storms and shutdowns that the skeptic is so worried about. This is them actively reinforcing the financial foundation of the company, brick by brick. Okay, so we've seen the premium cabin strategy, and we've seen the balance sheet fortification. But the real power, the hidden asset that the market so often misunderstands or undervalues, is the loyalty program. We call it the A Advantage engine. And I'll concede this to you. If there is a legitimate bull case to be made for this company, this is the linchpin. This is the one piece of the business that doesn't feel like a heavy Rust Belt industrial company. But you have to prove it. You have to prove that this engine is powerful enough to offset all the volatility we know exists in the rest of the business. We need to see the numbers. All right, let's do it. Let's look at the official breakdown from their 2025 results. You see passenger revenue there at the top, nearly $50 billion. A huge number, right? Then you see this little line item down at the bottom, other revenue, at $4.2 billion. It looks small, almost like an afterthought. But here's the secret sauce. That other revenue is almost entirely dominated by the loyalty program, specifically selling A Advantage miles to their credit card partners. And here's the kicker. While the passenger business of actually flying planes operates on a razor-thin, single-digit margins, the loyalty business is practically pure profit. It's a high-margin, capital-light, recurring revenue, tech-like business hiding inside a capital-intensive airline.
That $4.2 billion is the most important number on this entire slide because it contributes a massive, outsized portion of their actual profit. And that engine is accelerating. This is not some theoretical asset. Look at the data points here. AAdvantage enrollments grew by a whopping 12% last year alone. Spending on their co-branded credit cards is up a strong 8%. These are powerful growth metrics that show increasing customer engagement. And here it is, the critical link back to our previous point about the premium strategy. Those loyalty members, the people who are most deeply engaged in this program, account for roughly 75% of their total premium revenue. The two strategies are not separate. They are completely symbiotic. The loyalty program identifies and funds the premium traveler, who then turns around and pays top dollar for the high-margin seats. It's a self-reinforcing flywheel of profitability, and it is just getting started. So the big question is, does this all actually work? Does this fancy strategy translate into real dollars? Well, this quote right here pulled directly from the earnings call is the ultimate proof point. This is the hard data. Even in that disastrous fourth quarter we talked about, the premium strategy was the one shining light. The revenue they generated from the front of the plane dramatically outperformed the back of the plane by a full 7 percentage points. What this demonstrates, beyond any doubt, is that the pivot is not just a plan on a PowerPoint slide, it's already delivering superior financial results on the ground in the real world. It is actively widening the profitability gap and proving the concept works even under severe real-world stress. So now we have the two competing narratives laid out on the table. On one side, you have a disastrous quarter and a market that is just riddled with doubt. On the other side, you have a clear, focused strategic pivot with a powerful, high-margin engine driving it from behind the scenes. So it's time to put them head-to-head. We need to weigh the structural weaknesses that were exposed in Q4 against these new strategic reinforcements and see, once and for all, which one is stronger. This is the absolute core of the investment decision you have to make.
Okay, let me just recap the bear case. It's really straightforward. 1, they delivered a massive earnings miss that fundamentally damaged their credibility. 2, their performance proved, without a doubt, that they are highly vulnerable to external shocks, which, by the way, are becoming more frequent, not less. And 3, as a result of 1 and 2, there is a deep and, I'd argue, rational market skepticism that's baked right into the stock price. If you buy this stock, you are betting against a powerful tide of disbelief, and that is a very dangerous bet to make. The risk is high, the volatility is proven, and the recent performance is poor. And the bull case is just as clear. The demand engine is hitting all-time records, period. Management is aggressively fortifying the balance sheet by paying down debt ahead of schedule. And most importantly, they have a powerful synergistic strategy combining premium cabin growth with a high-margin loyalty engine that is already showing superior results. You are betting on a strategic pivot that is already well underway, buying into a business that is fundamentally changing its profitability profile for the better, right before your eyes.
And this whole debate comes down to this one simple chart. This is the bet you're making. The street consensus, which represents the skeptical view, is sitting at $1.97 for 2026 earnings. But management, because they see the momentum in their premium and loyalty strategy, is guiding to a midpoint of $2.20. That 23-cent gap is where the entire battle is being fought. Management is showing extreme confidence in their blueprint. Yeah, confidence or hubris. The market is saying that guidance is a complete fantasy. That 220 number doesn't account for the next winter storm or the next political food fight in Washington. It's a perfect world number in a very, very imperfect industry. The entire investment thesis, everything we've talked about, boils down to whether you believe this management team can navigate the inevitable chaos to deliver on that promise.
All right. We've examined the cracks in the foundation. We've inspected the new steel frame that they're building. We have stress-tested the numbers in the strategy, so now it is time for the final assessment. Is American Airlines, at this price, with this level of deep-seated skepticism, a powerful opportunity to get in ahead of a major turnaround? Or is it a classic value trap that will just continue to burn investor capital for years to come?
Our framework for making this decision leads us right here. Step 1, you have to acknowledge the Q4 damage. The miss was real, it was bad, and it created a major credibility problem. You absolutely cannot ignore this. Step 2, you must validate the strategic pivot. The shift to premium seating and the underlying power of the AAdvantage program are also very real. The data shows this is a sound, high-margin strategy that is already working. Which brings us to step 3, assess the credibility gap. This is the human element. Do you trust this management team to execute this sound strategy in an incredibly turbulent environment? The company has a stronger frame now, no doubt, less debt, a better profit engine, but it still exists inside a building that is constantly being shaken by forces way beyond its control. And that means step 4 is really about your personal tolerance for that turbulence. It's about weighing the risk versus the reward. The potential reward is capturing the significant upside if they actually hit that 220 EPS number and the market is forced to re-rate the stock, meaning reevaluate it at a much higher price. The risk, of course, is that another external shock comes along and derails the whole plan. So, to validate the bull case going forward, here's what you do. Watch two numbers every single quarter: premium cabin revenue growth and the pace of debt reduction. Those are your proof points.
So this is the final question we're going to leave you with, the one you have to answer for your own portfolio. There is no doubt that American Airlines has forged a stronger financial frame. The strategy is more robust, and the balance sheet is more resilient than it's been in years. But the central question remains: is it strong enough? Can their premium cabin revenue continue to outpace the main cabin, and can they keep paying down that mountain of debt even if another storm hits or fuel prices spike? Is the new structure they've built durable enough to withstand the inevitable turbulence that we all know is coming, because another storm is always on the horizon? Your investment decision hinges entirely on your answer to that single question.